Have you ever looked at a tiny blue flame on a camping stove and wondered, who actually owns this? Most people think of big oil, but they're looking at the wrong scale. There is a silent giant in Korea that literally fuels 60% of the entire planet's portable gas needs. If they stop, the world's outdoor industry goes dark. Today, we're dissecting Taeyang Corporation's 2025 secret sauce. It's not just a company, it's a global moat so wide you could sail a tanker through it. Let's look at the scorecard. In 2025, their top-line revenue hit nearly $100 million. Now, you might see a 7% dip in sales and think, is the ship sinking? Not even close. Their profit actually shot up by 43%. Imagine making slightly fewer sandwiches, but ending up with 40% more money in your pocket at the end of the day. How? We'll get to that legal windfall in a minute, but the real story is that their machines are running so hot, they're at 99% capacity. That's like a restaurant having every single seat filled 24/7. In Korea, Taeyang isn't just a player. They are the referee, the coach, and the stadium owner. Between them and their sister companies, they control 67% of the market. To put that in perspective, for every 3 portable gas cans sold in Korea, 2 come from the same family tree. Their biggest rival is sitting at 27%. It's like a race where Taeyang is on a Ducati and everyone else is on a bicycle. Here's the wait what moment of the year. Look at this chart. Revenue is sliding down, but net profit is jumping like it's on a trampoline. Is it magic? No, it's a $7.4 million I won in court check. They settled a massive lawsuit, which is great for the bank account this year, but as analysts, we have to ask, what happens next year when there are no more lawsuits to win? We need to look at the bread and butter business. Why do people pay a premium for sun fuel? Because nobody wants their Sunday barbecue to turn into a Michael Bay explosion. In the gas business, safety is the ultimate luxury brand. Taeyang has been the world-class gold standard since 2009. While low-cost rivals from overseas try to undercut them on price, Taeyang is winning on the "I don't want my stove to leak" factor. That's a moat made of trust, and it's incredibly hard to replicate. The market is getting crowded at the bottom, but the top is turning into a 2-horse race. While the smaller guys are getting squeezed out, dropping to just 2% or 3% share, the big rival, Daryuk Can, is creeping up. They've grown from 25% to 27%. It's a classic duopoly setup. The small players are the snacks, and the big two are having a feast. Check out this factory. It looks like something out of a sci-fi movie. This is why they win on cost. Their utilization is 98.87%. In consultant speak, that means they are squeezing every single drop of value out of their machines. If they were a heart, they'd be beating at 180 BPM without breaking a sweat. Most factories are happy with 80%. 99% is basically showing off. Let's look at what's inside the revenue pie. 84% is their core gas business, their cash cow. It's reliable, it's steady, but it's full. There's no more room in the inn. Then you have the aerosol segment. Think hairspray and bug spray. It's only using 28% of its capacity. This is like having a spare bedroom that's currently just storage. If they can turn that 28% into 80%, that's where the next moonshot profit comes from. How sensitive is this business? Well, they are at the mercy of 2 things, the price of gas and the price of the metal cans. Gas prices went up slightly, and metal went down. It's a balancing act. But here's the kicker. They have pricing power. When costs go up, they can actually raise prices for international customers by nearly 4%. That's the benefit of being the world leader. You tell the market what the price is, not the other way around. This is the pivot of the year. Taeyang is packing their bags and leaving their heavy production site in China. They sold their stake for $2.8 million. Why? Because owning a giant factory in a volatile market is heavy. They're moving to an export-first model. They'll still sell to China, they just won't own the plumbing anymore. It's about being asset-light and cash-heavy. Let's talk about the war chest. These guys have a current ratio of 569%. In normal person terms, for every $1 they owe soon, they have $5.70 sitting in the bank. They have $54 million in walking around money. They aren't just stable, they are Fort Knox stable. This gives them the power to wait for the perfect moment to buy a competitor or invest in a new tech. Taeyang is tired of just being the factory guy for other brands. They are moving into ODM original design manufacturing. Instead of just filling cans, they are designing the formulas for high-end cosmetics and medical sprays. This is where the big money lives. It's the difference between being the guy who builds the house and the architect who designs it. What's the 2026 game plan? Q1 is all about cashing that China check. Q2 is taking over the American outdoor market. Q3 is launching those fancy new sprays we just talked about. And by Q4, shareholders might be looking at a nice thank you check in the form of a dividend hike. It's a disciplined, step-by-step climb to the top. So what's the verdict? The good. They are a global oligopoly with a fortress for a balance sheet. The risk. It's a family-run business. They own 62%, and they are highly sensitive to energy prices. If butane prices skyrocket, it hurts. But if you're looking for a defensive giant that's transitioning into a high-margin future, Taeyang is hard to ignore. This was just a surface-level dive into a very deep ocean. If you want the full-page institutional report on the energy and chemical sectors, you know where to find us. Drop a comment below. Do you think the move from China is a masterstroke or a mistake? Don't forget to email our team at sales@hdinresearch.com for bespoke market intelligence. I'm from HDIN Research, and we'll see you in the next deep dive.